so much for joining in. You are guiding for growth in the second half of the year to be better than the first half of the year. If you could, throw more color, some numbers, what is the kind of growth we should expect, considering that we are seeing a second wave of COVID infections in US and Europe?
That's right, Rima. So we did expect, a recovery from low of Q1 one quarter back, and we were somewhat surprised by the positive momentum that we saw in Q2, which was primarily led by sharp recovery in our Italian business. As you rightly said, there is an impending second wave and some lockdown measures are being taken in European countries. And that may have some bearing, although the world and our clients and ourselves are much better prepared now, and hence the impact of that second wave is likely to be less than what we saw in Q1. Based on these factors and the current pipeline, we have said that H2 will be better than H1.
Right, Rohitash, for FY21 and FY22, could you, in the ballpark, give us a guidance for revenue growth, dollar revenue growth?
So Prashant, that will be a tough ask to do, especially in the current environment. We have never given a firm guidance even in the past. Last 4 years have been somewhat flattish at about $200 million in revenue terms. And currently, H1 was badly impacted because of COVID. And to the extent we see the recovery in H2, I think that will set the tone of for FY22 and onwards. But we do expect some growth going forward, at least given the spends that are happening in digital and automation areas, where we are likely to have increased market share going forward.
Rohitash, will H2 FY21 be better than H2 FY20? And secondly, your outlook on margins for the coming 2 quarters.
So Rima, even that is a derivative question, and I would refrain from answering whether it will be better. But definitely, at least the H1 to H2 momentum is very clear in our mind that it will be uptrend. In terms of margins in H1, particularly in Q2, I think we were beneficiaries of some of the cost savings led by closure of offices and also sharp reduction in travel spend that we used to have. And some of this will stick, but some of this will vanish also as the normalcy returns and the business travel will happen for various client meetings and new projects, etc. So I think you have to take the H1 margin in perspective that only some of the savings will be retained going forward, but some of the savings will go away. So I would say somewhere the reality will lie between the FY20 margins and the H1 margins when the normalcy returns.
So 22, let's look beyond H2 of this year and look at FY22. Would margins basically come back in the 22 to 23% range?
So, Prashant, even internally, we endeavor to increase the profit pool, the PAT, where we have seen reduction for last few years. And if you look at the H1 and particularly Q2, we did about 61 crores. So if we can keep this momentum, I think this year could be a better year from PAT perspective. And depending upon the revenue growth into FY22, I think that will determine what the absolute PAT in FY20 will be. But obviously, the endeavor is to keep growing from the low of FY20.
There is a sharp reduction in your India seat count, by 4-5%. Do you expect more pruning of your staff costs?
So the seat count reduction was because of some space rationalization that we did. And as you can clearly see, we have global staff count of about 8,500, whereas the India seat count alone is more than 9,000, and we do have shift-based working. So we clearly had some excess space, and we took this opportunity because of work from home, etc., to reduce some of the space. But that's about it. We are not looking for any more reductions in the space.